Ahoy! Wednesday night, 8 p.m. Eastern. It can only mean it is another delicious episode of Taxes and Retirement Live. Hold on, Taxes and Retirement Live, I says. Where'd it go? Yeah, I am Andy Panko, moderator of the Taxes and Retirement Live group, and your host for this evening. And this evening's topic will be all about estimated taxes and withholdings. The more I read that, the more weird it looks that there's two H's in withholdings, but so be it. So popular topic, not a topic people enjoy. It's often in your face when you go from a life of working, particularly if you work for someone else and have wages. You don't really think much about paying taxes. Taxes, both federal and state, if you're in a state that has taxes, are usually just kind of magically taken out of your paychecks and paid straight away to the U.S. Department of Treasury or your state, or your state. So it's pretty easy. Now, if you don't pay enough, you can kind of dial up your paycheck withholdings a little. If you pay too much, you can dial it back. But once you stop working and your wages go away, then you often have to think much more about how you pay tax. You may still have some sources from which you can have taxes withheld, but sometimes you don't, and you have to make estimated payments. Much more involved and calculated, and more ways for things to go wrong with it. In terms, by wrong, I mean not paying enough, in which case there could be interest penalties on not paying enough. So that's tonight's topic. It's a fun one. We've gone over it before, but questions, and rightfully so, people just continually have questions about this. And hey, I did this, and how much tax do I have to pay, and when, and can I pay now instead of later, or later instead of now? So that's what we'll get into tonight. Before doing so, I will give you the father jokes for the evening. Current events. You think gas prices are expensive. Have you seen chimneys? They are through the roof. I will tell you. In Britain, they call it a lift, but Americans call it an elevator. I guess we're just raised differently. And finally, let me cue up my little friend. 97% of people are stupid. Thank God I'm in the other 5%. One of my favorite comments, and the beauty of it is you can say it different every time and it still works, is anytime someone says some number or statistic, I say, well, 66% of statistics are made up. Let that soak in a little bit. My kids always get a chuckle at that. Well, now it's getting old. They don't chuckle at it anymore, but they used to when they first started learning about math and statistics. And I would say something like that. They got a kick out of it. Comments are working. Yes, just looking at comments. Happy spring, all. Indeed. What's this? Postpone doing my estimated taxes today when I saw a topic. Yes. Whoever this is, hopefully that you'll find this incredibly useful and valuable, or to leave you banging your head against the wall that much more. How many telemarketers does it take to change a light bulb? Only one, but he has to do it while you're eating dinner. Just good one. And finally, nice stubble. Yeah, I just realized I don't like shaving. I try to shave like once a week, and usually time it depending on if I have something else going on where I should look a little more presentable than normal, or less unpresentable. And I'm just looking now, like I don't really do stubble well. It doesn't fill in that well. Looks kind of weird, but whatever. I'm just lazy. I don't like shaving. Okay. Let me one question before I jump into it. I just see a question here. I'll do it now. Otherwise, I'll try to save questions for the end. Thomas Wang asks, I would like to extend filing this year. How do I know how much estimated I have to pay now? So you're asking about doing an extension for your filing. Everyone has to file by April 18th this year, and anyone can do an extension until October 15th, I think it is. I don't know if that lands on a weekend or not, but let's assume it's still October 15th. Reason to do it. There's a form you have to file to do it. I forget what it's called. 45 something. I don't know, whatever. Pretty straightforward to do. But doing an extension, it's only an extension of the time to file your return. It's not an extension of the time to pay what's owed, which is weird. And this is, I'm sure your questions come from Thomas. You still basically have to pay the tax you're supposed to pay by April 18th. You just don't have to submit your return until October 15th if you do an extension. So that raises the question, well, how do I know how much I have to pay? You basically still have to go through your return for all intents and purposes. You need as much information as you can get. Whatever info you're still waiting on, you kind of have to ballpark and estimate it. So you do, in effect, need to do like a trial run of your tax return to figure out what you roughly think you have to owe for the year, or refund, whatever it may be. Let's assume you think you owe. You do kind of need to do a complete return or close to it. And let's assume it's $1,000 you have to owe. You would have to pay that $1,000 when you file your extension, or pay it by April 18th at least. You can get your extension and then not formally submit your return until October 15th or whatever the date is this year. Hopefully that answers your question, but you basically do have to do your full return now to figure out how much you think you have to pay thus far. Okay. Disclaimer. How can I forget the disclaimer? This video is only general explanations and education. It is not specific tax, legal, investment advice. Before considering acting on anything you see in this video, first consult with your tax, legal, or investment advisor, which I am not. I am some guy, ill-shaven, in a Delaware shirt, talking about estimated taxes tonight. I'm just some random bloke on Facebook. Do not take anything I say tonight as tangible or actionable advice specific to you or your circumstances. All right, let me pull up my slides. I coincidentally did this exact same topic in the Rock Retirement Club a couple weeks ago, so I'm going to be lazy and just reuse the slides I did there. They're good slides. I like them, so there's really no point in redoing them. But you'll notice there is some Rock Retirement Club branding on it. Okay. So this is going to be a bit of an educational lesson as well, because without appreciating, understanding the background of how taxes are paid and why, you can't fully get the difference and relevance of doing estimated payments versus withholdings. So bear with me as I give a little bit of an educational spin here. So the U.S. income tax system is what's called a pay-as-you-go system, where the expectation is as you earn or receive taxable income, you're supposed to pay tax on it at the time. So like when you receive wages, for example, you get paid every 2 weeks, let's assume. The taxes for that pay period of wages, the taxes get withheld, automatically sent away, like I said, to the Department of Treasury for the federal or your state. That's paying as you go. Again, you don't think about it, just sort of happens. Which is good because that's how it's supposed to happen. Or if your income isn't just simply from wages, it's lumpy, or it's self-employment where there's no one to make withholdings for you, or you get like sporadic gambling winnings throughout the year, or you do sporadic Roth conversions throughout the year, you're supposed to pay tax on the income as you realize it or earn it or get it or whatever you want to say. Now, the IRS doesn't go so far as to say you have to pay it like the day you receive it. They instead break it up into quarters. You're supposed to pay the taxes attributable to the income you have for that quarter. You're supposed to pay the taxes in that quarter. And I'll show you the calendar dates for quarters. They're not calendar quarters. The IRS has to be difficult, and it's slightly different. It's not just 3 months, 3 months, 3 months, 3 months. But you're supposed to pay as you go. Hold that thought for now. You'll see why that matters. There's two ways in which you can pay taxes. You can do it through withholdings, and I already touched on this. Withholdings are if you have a source of income like wages, you can have the payer of that income, i.e. your employer, withhold taxes on your behalf and send them to the Treasury and the state on your behalf to pay your taxes for the year, or some of your taxes for the year. Or you can do estimated payments. Estimated payments are different. It's not the payer of your income withholding and directly sending that money to the taxing authority. It's you having to consciously either write a check or go online. I got something in my eye. Or go online and set up a bank ACH transfer, or you can pay by credit card to the IRS and some states, I assume, although there's a fee for it. It's like 3% fee for the IRS, so don't pay by credit card if possible. So estimated payments, you have to, intentionally set these things up and pay them on the dates you decide to pay them and the amounts you decide to pay. Now, how do you know the dates and amounts? We'll get to that. But point is, you have to consciously think about making estimated payments. It's not like your employer is just simply withholding taxes for you. You have to make estimated payments. Now, there's sort of other ways, but not really. You may say, well, why can't I just pay nothing throughout the year and pay it all with my tax return? Why isn't that a third way? I guess it is, but you should typically not do that because it is a pay-as-you-go system. You're supposed to be paying tax throughout the year, not just waiting, racking up a fat tax bill and pay it all in April of the following year. You can, but you'll likely have underpayment penalties if you don't, because you're supposed to be paying as you go. Or another way you can do it is, and this is not really a third way either, you may say, well, if I have a refund on my return, I can simply roll that over and apply that refund towards the next year's taxes. Yes, you can. That's technically and functionally just a form of making an estimated payment is all that is. So you can sort of wrap that into point two here. Now, you all probably know this already, but to the extent you overpay tax withholdings or estimated taxes for the year, more so than you ultimately needed to have paid for the year, you'll get a refund at tax return time, or vice versa. If you don't pay enough, you'll have to pay the extra of what you owe when you do your tax return. Next, withholdings. So there's a handful of sources from which withholdings can be withheld for both federal and or state. Wages, obviously we touched on that. Social Security, you cannot do state withholdings for Social Security. You can do federal, and there's only, I think, 4 pre-canned withholdings you can have. I think 0%, 10%. That might be a 17, if I remember correctly, a 22, and maybe something else. So Social Security is one. IRA distributions. If you have an IRA somewhere, you can elect how much to have withheld anywhere from 0 to 100%, typically, usually in increments of 1%, or you can specify a particular dollar amount. Pensions. If you get a pension, you can have withholdings from that. Annuities, same thing. Annuity payments can have taxes withheld. Unemployment compensation. Gambling winnings, actually. There may be 1 or 2 others, but these are the majority of them, or at least the ones you're most likely to see. I'm not off the top of my head aware of other things from which you can have taxes withheld, but it's possible that there are some, but these are the big ones. Now, this point's important. When you do make estimated payments, whether you have them made in January, in December, or any point in between, or any combination of months, or any frequency or periodicity throughout the year, the IRS takes your total withholdings that you made for, and most states do as well. If you pay state income tax, they'll take your total withholdings you made for the year and treat them as if you paid them evenly throughout the year. So let's just assume on January 1st, you withheld $120,000 of federal tax. Or you in December 31st, you withhold $120,000. Doesn't matter. The IRS will treat it as if you withheld $10,000 a month, every year throughout the year evenly. That's good. That's a huge benefit about withholdings, and you'll see why. Estimated taxes or estimated payments, I touched on this, but you can make them a few ways. They're not withheld out of pensions, Social Security, wages. Those are withholdings. That's a different form of payment. Estimated payments are you consciously making a payment on your own. You can pay by physical check. You can mail it into the U.S. Department of Treasury or your state, or like I said, there's a website for the IRS. At least here's a link to the site. Each state that has an income tax will have its own link. Just Google it. They usually, these links are easy to find for each state. But you can go to the IRS website. You can set up a payment, again, through ACH bank transfer, which is no charge, or credit card payment, which I think is like 3% roughly. Here's the rub with estimated payments, and here's where things get tricky. You are supposed to figure out at the beginning of the year what your total tax obligation is going to be for the year. And you're supposed to then take that, break it up if you're making estimated payments as opposed to withholdings. Because again, if it's withholdings, it doesn't matter when in the year you pay it. You can pay withholdings at the beginning of the year, end of the year, any point in between, you're good. You don't have to worry about the timing element of paying as you go. With estimated payments, you do need to plan ahead. If you don't have sources from which you can make withholdings and you need to make estimated payments, you're supposed to plan ahead, know what your total income is going to be for the year, know what your total tax bill is going to be for the year, break that up into 4, and make 4 equal estimated payments throughout the year, paid by each respective quarter due date, which I'll show you in another slide or two. Now, here's where things get even trickier, but it can help you avoid the having to do 4 payments if you don't know with certainty what your income is going to be, and therefore can't break it up equally into 4 payments throughout the year. If your income is lumpy or unknown, so like your work, I don't know, you got a side hustle, but it's seasonal. Like maybe you do some landscaping on the side, and you're really busy in the spring, maybe in the fall, and that's kind of it. But you don't know how much work you're gonna get and when. Or more common for retirees is things like Roth conversions is a big one. at the beginning of the year, you don't plan on doing any conversions, let's say, and all of a sudden in June, you decide I'm going to convert $100,000. Well, that's now $100,000 of taxable income that you weren't planning on, and therefore you couldn't have known in the first quarter that you should have been making estimated payments for it. So now what do? There's a way you can what's called annualize your income on part of your tax return, specifically on Form 2210. Takes a little work to do, but what you do is you manually allocate your total year's worth of gross income. You break it up and say, okay, this much gross income was realized in this quarter, this much was in this quarter, this much was in this quarter. So that way you can say, okay, look, I didn't have any gross income in the first quarter, let's assume. All of it came in June when I did this Roth conversion. So therefore, I didn't ultimately owe any tax in the first quarter because I had no income then. So the estimated tax payment I'm going to make now is going to be for, I guess this would be the third quarter actually, because it would be June. So I would have to annualize my income at the end of the year to manually account for which quarters the income happened, and then I would make my estimated payments throughout the year based on the quarters in which I earned that income. So you can see this is already a lot more work, whereas with withholdings, you can just simply have the withholding made whenever, and you're good as long as you withhold enough to cover that year's tax bill. I'm sure you all have a lot of questions, so I'll definitely get to it. I'm just kind of going through these slides first because this is the base of all this stuff. Now, underpayment penalties. Sounds scary, sounds dangerous, and it is technically called a penalty, but functionally it's nothing more than interest. So don't worry about it. If you do have an underpayment penalty, they're not going to, the IRS doesn't show up in handcuffs with handcuffs and take you away. All it really is saying, hey, you're supposed to have paid X amount of tax throughout the year and you didn't. Even if you end up paying at tax return time, great, but too late. You're supposed to have paid, throughout the year, but didn't. So the IRS will charge you, and the states will as well. They'll charge you interest on the amounts you should have paid but didn't by those quarters' respective due dates. That interest rate is currently 3% annual. It's going up to 4% starting in April. 3% is the lowest I think it's ever been, perhaps, and it's been there for a couple years. I don't know what the highest it's been, but it is going up to 4% pretty soon. And the important thing to know is it's not. It's 3% or 4% is the annual rate. But if let's go back to the example of you had no income in the first half of the year, you made a big fat conversion in June. You didn't know or decided not to pay any estimated taxes. You're like, I'll just worry about it when I file my return in March or April. So now comes tax return time. Your only income was $100,000 of conversion in June, let's assume. You're going to have to do this annualization thing on your tax return, because if you don't, the IRS is going to assume, and let's assume on that $100,000 you owed $15,000 of tax, total tax for the year. The IRS is going to say you should have paid that $15,000 in 4 equal payments. Let's pick an even number. $16,000 is your total tax. So the IRS is going to say you should have paid $4,000 in taxes 4 times throughout the year. 4,000 in the first quarter, 4,000 in the second, 4,000 in the third, 4,000 in the fourth. Since you didn't, they're going to start charging you interest from the end of the first quarter. So which would have been April 1st, April 15th was when it was due. They're going to start charging you interest on $4,000 from April 15th onward. And then the second quarter due date is June 15th. You should have paid another $4,000 by then. So from June 15th onward, they're going to charge you interest on that from June 15th onward, and still continuing to charge you interest from the first quarter's payment you hadn't yet made. And the third quarter's payment, same thing. They'll start to clock at the end of the third quarter. Fourth quarter, same thing. So even if you are short and underpaid for the year, it's not like this 3 or 4% annual interest applies in its entirety and the whole amount. No, it's broken up and sliced and diced into each quarter has its own different accrual period. So these underpayment penalties aren't necessarily horrific unless you underpay tax by tens of thousands of dollars. It's not huge. I did an example a few weeks ago with a mock tax return where I think they were short, like, what was it? I don't remember. $30,000 maybe of tax they didn't pay. And the underpay, no, was it that high? Whatever. It was at least $10,000. I don't remember. But the underpayment penalty was like a couple $100 or something. If you're only short by a couple $1,000 in tax, your underpayment penalty will be like tens of dollars. It's not going to be hundreds or thousands. So they're not horrible. You don't necessarily, it's not the end of the world if you have an underpayment penalty, again, unless you're short tens of thousands of dollars in tax, then these things will start to add up. Or it's going, oh, but anyway. So yeah, by default, the IRS will assume your tax should have been paid in equal quarters. Or in the case I gave where you did a one-time conversion in the middle of the year, you'll have to annualize your income on your return, and that will in effect waive any tax obligation you had for the first quarter because you had no income in the first quarter. So in this case, the interest clock wouldn't start. That was technically the third quarter. If you did it in June, it'd be the third quarter that you did this Roth conversion. So you wouldn't have to pay estimated taxes until the third quarter. So there would be no penalty for first quarter, no penalty for second quarter. There'd just be a penalty from third quarter onward if you didn't pay enough estimated tax by a third quarter. Tricky, right? Yeah. So goes it with taxes. Never easy. Oops. Here are the quarters. And as I said, the IRS doesn't use equal calendar quarters. The first quarter is 3 months, January for March, where the payment date for first quarter is April 15th. Second quarter is only 2 months. It's April and May, where the payment date is June 15th. Third quarter is 3 months, June, July, August, where payment date is September 15th. And the fourth quarter is 4 months, September, October, November, December, where the payment date is the following, 2 weeks later, June 15th the next year. Now, these payment dates are, if it lands on a weekend or holiday, they're bumped out to the next available or the next business day. So commonly happens on weekends. And this year, actually, the payment date is April 18th. Because not only is there a weekend in the mix, but there's Patriots Day. I think it's Patriots Day, which is a holiday observed in Massachusetts and DC maybe, but it gets everyone in the country an extension for another day. So April 18th is the tax payment deadline this year for fourth quarter of last year. What else do I have here? Oh, so okay. So how do you actually figure out if you owe estimated payments or what you should make? There's a link at the bottom to this. This is actually very helpful. It's not short, it's not easy, but that's simply because there are so many things that go into it. So as I alluded to before, you basically have to figure out at the beginning of the year what you anticipate your tax return is going to look like for the year. You kind of need to know all of your sources of taxable income. You need to know all of the deductions and credits you're going to have, if any. These things all get thrown into a pot and boiled to come up with what's my total tax obligation for the year going to be. That then is what you have to pay by either withholdings and or estimated payments. And again, if you're doing estimated payments, you should break them up into 4 equal parts. Or with a little more work, you can annualize it if your income isn't going to be received evenly throughout the year. You can annualize your income and then pay the taxes in the quarter that the income is recognized or received. So the IRS has a really good tool for this. You click on this begin thing and it walks you through. It's a guided sort of question prompt thing that in effect has you kind of fill out all the stuff you'd fill out in a tax return. It just asks you in like whatever prose form. I don't know, whatever. I'm not an English major. In question form, as opposed to giving you a table you have to type stuff into. It'll ask you your anticipated sources of income. It'll ask you what withholdings you're going to make, if any. It'll ask you for certain credits and maybe applicable, tax credits may be applicable to you. It'll end up with a number. Here's how much tax you're going to owe. Here's how you can pay it. Make withholdings of ABC or make estimated payments of XYZ. So really good tool. Or if you have and use or will get tax return preparation software, you can simply run stuff through that. So like for those of you that use TurboTax, I believe TurboTax has a next year planner functionality to it. You may have to pay extra for it. I don't know. Like commercial tax prep software has it, like stuff I use, and I use it myself personally and for clients. This is what I do to do income tax projections: is actually run through, a pro forma 2022 tax return for everyone. But point is, if you have TurboTax or other tax prep software you use, it likely has the ability for you to plug and play and do an actual mock 2022 tax return, so you can see what your anticipated total tax is for the year, which in effect is all this IRS site's doing, frankly. So either way, whatever you're more comfortable with is really the only way to go about figuring out your estimated taxes. Or if you have a really beefy, robust spreadsheet that does this, you can do it as well. There are free ones out there. I forget the name of it, but there's some guy for free who makes a really robust spreadsheet that in effect replicates the entire 1040 and all of its various schedules, freely available. So that's something to use. Now, he doesn't guarantee its accuracy, so kind of use at your own risk. But from what I understand, the guy puts a lot of time into maintaining it and making sure it's accurate, or at least close to accurate. So that's how you can figure out how much you owe or will owe for the year. Estimated taxes. This is a long one, but this is what you can use to figure out, if I don't make estimated payments, am I going to have an underpayment penalty? That's what this table is getting at. And this is right from IRS publication 505, which is the IRS publication about making estimated payments. So just follow along here. There's some things called safe harbors, which are, they don't use that term here, but that's what they're kind of referred to. These are things that if you do pay at least a certain amount, even if you don't pay your entire tax bill for the year throughout the year, if you pay at least a certain amount, you'll be exempt. You'll be safe harbored from having to pay any underpayment interest penalties for the year. So that's what this table is getting at. So let's just start at box 1 and walk through this thing. Will you owe more than $1,000? And this is 2021. You can apply this for any year though. Will you owe more than $1,000 after subtracting income tax withholdings and refundable credits from your total tax? Don't subtract any estimated tax payments yet. So the example would be, let's assume you're retired, you have withholdings from a pension or Social Security, but you may not withhold enough that way. So quick example, your total tax obligation for the year is going to be $10,000. You're going to have $9,050 withheld from your Social Security or pension. So you're going to end up owing $950, if I did the math right, in tax at the end of the year because you didn't pay enough. Well, that's okay, because so long as you owe less than $1,000 additional dollars of tax on your return, you'll be exempt from any interest underpayment penalties on that additional $950 that you owe. But the key is the amount of tax you did pay throughout the year came through withholdings. Okay. So this is just telling you, in addition to my withholdings, do I have to make additional estimated payments on top of it to avoid penalty? If you meet the conditions of box 1, no, you don't. You can just pay what you owe, clean up the rest at tax return time. Let's assume you will end up owing more than $1,000. So box 1 doesn't apply. Now move on to box 2A. Will your income tax withholdings and refundable credits be at least 90% of the tax shown on your return for the year? Or there's a caveat, if you're a farmer or fisherman, I'll assume most of you aren't, but if you are, you only have to meet 2/3 or 66 2/3% of your tax. So the example here is your total tax obligation for the year is going to end up being $100,000, let's say. As long as you pay throughout the year by way of withholdings, at least 90% of that, or $90,000, you'll be okay in that you won't owe any underpayment penalties. So even though you're going to end up still owing $10,000 when you do your return at tax return time, you won't have any interest underpayment penalties on it because you will have withheld at least 90% of your total $100,000 tax obligation for the year. So that's another safe harbor. Safe harbor 1 is that $1,000 thing in box 1. Safe harbor 2 is box 2A. Again, if you withhold at least 90% of your total tax obligation for the year, regardless how much you end up still owing at tax return time, you'll be exempt from underpayment penalties for the year. If you don't meet box 2A, so let's assume you're not withholding at least 90% of this year, well, now you look to box 2B. Will your income tax withholding and refundable credits be at least 100% of what your prior year's total tax obligation was? And there's a double asterisk here. It's 110% if your prior year's adjusted gross income was 150 grand in the year before. So the example here would be, extreme example. Let's assume last year your gross income was $50,000. Your total tax obligation on that was $10,000, just to pick a number. This year your income is going to be $1 million. Good for you. You had a really fat bonus or something. And you only withhold 20 grand for the year, right? So let's just, on $1 million, your tax is going to be $400,000. Let's say that's too high. 300 something, whatever, 400. We'll go with 400. So your total tax obligation for this year is going to be $400,000, but you only withheld 20 grand this year. So you're going to end up owing $380,000 of additional tax when you file your return. But that's okay, because last year you only made 50 grand. Your total tax obligation for the year is only 10 grand. You already withheld more than that this year because you withheld 20 grand this year. So you meet this condition. You withheld at least 100% of last year's taxes already by withholding 20 grand. So you're good. You won't have underpayment penalties. You're still going to owe $380,000 or more tax when you pay your return, when you pay your tax when you file your return, but you won't have any underpayment penalties on that. See, that's the third. That's this other safe harbor 2B. So if you're new to these safe harbors, it may take a while to kind of wrap your head around and think about when you get these, these safe harbor exemptions and stuff. But important to know, another extreme example, if you had zero taxable income last year and therefore zero tax obligation, you don't have to withhold any tax throughout this year. Now, you'll ultimately still owe tax if you do have income this year. You'll still owe tax with your return, but there won't be any underpayment penalties because 100% of zeros last year tax is zero, which means you don't have to withhold anything this year. You can just pay it all at tax return time if you want to. Anyway, so if you don't meet any of these three safe harbors, you will have to pay estimated taxes to some amount, and what amount you can use on that previous slide, that IRS tool. You will have to pay estimated taxes to avoid underpayment penalties. If you don't pay estimated taxes, just wait to pay all your tax with your tax return. You very well may be subject to underpayment interest penalties. So that's the safe harbors. Again, little thick and tricky if you haven't thought about or seen these before, but this table is quite helpful. Again, it's from IRS publication 505 if you want to take a look and look at it at the source. What else do I have? Takeaways before I get into the questions. So tax system is pay as you go. If possible, pay taxes through withholdings as opposed to estimated payments. Withholdings are so much easier. You don't have to worry about timing. That's the big benefit of them. If you are making estimated payments, ideally try to be able to plan out the whole year in advance to know what your total income and therefore total tax obligation is going to be. Pay that in 4 equal payments or some combination of withholdings. So you can pay some of your tax through withholdings and the rest of your tax obligation through 4 equal estimated payments if you want. Or let's just assume you don't have anything to withhold from, so you have to make estimated payments. Ideally, do it in 4 equal payments. Or if you can't or you choose not to because you're going to have unforeseen amounts and timing of income throughout the year, you can wait and pay the taxes in the quarter that you get the income, and then at the end of the year when you do your return, it's going to take a little more work to annualize your income on Form 2210. All right. That's all I have for slides. Let me take off the share and go to questions. Looking grizzled. Yeah, it's my sloppy, ugly beard. A poor excuse for a beard. Start here. So I'm just going down in order here, starting at the top and working my way down. I have a question. I contribute to my 401k pre-tax, and they finally offered 401k Roth. I'm now contributing to Roth. I had is this tax? Is this estimated tax? Okay, it is tax related. Okay. I'm now contributing to Roth. I had 135,000 in contributions that were pre-tax that I made. I converted that money to a Roth about 3 weeks ago, and I know I will owe taxes on that money, which I will pay out of pocket outside of my 401k funds. Okay, good. I want to retire early. Thus the reason for moving money to Roth. My question is, when will I owe these taxes? Do I need to make quarterly payment before April? Question got cut off here, but I think I know where you're going with this. So yes, if you did the conversion 3 weeks ago, that is first quarter when you realize that $135,000 of income. So you can do a few things. If you have sources of income from which you can withhold, like your paycheck, you can have more taken out, but you're probably not going to be able to have enough withheld to cover the additional tax on 135 grand. So since you're going to be paying out of pocket, you have to figure out, basically do a tax return projection for the year or use that IRS tool. How much additional tax is this conversion gonna cause me? And yes, you should ideally pay that this quarter by April 18th. So get it in for first quarter because that's when you did the conversion first quarter. Get that estimated payment in both federal and state if you're in a state that has tax. You should ideally do it April 1st. Not ideally, but yeah, well, I don't want to say you have to. So you have 2 choices. If you're going to do this annualization of income thing on your return, yes, pay the entire estimated tax attributable to this conversion in the first quarter, get it done with and out of the way. Or you can just fold this 135 grand into your total annual tax and figure out the increase in tax due to this conversion, and you can space that estimated payment out over 4. So let's assume it's going to be $20,000 of tax just on this conversion. You can make a single $20,000 estimated tax payment now, or you can make 4 different $5,000 estimated tax payments spaced throughout the 4 quarters. It's up to you. If it was me, I would just do 20 grand now, get it out of the way. There is something to be said though for, well, why pay all 20 grand now when I can pay only 5 now, keep the other 15 in my bank, get some interest, and then pay the another 5, then another 5, then another 5. Yes, I mean that's accurate. Money has a time value, and you can get interest on that if you leave it in your bank. But if you want peace of mind and get it out of the way, you can pay all 20 grand now in this case. And frankly, depending how much tax you're paying, you're not going to get much interest anyway in a bank account, so you're not really giving up that much. Good question. Yeah, here we go. Social Security tax withholding, 7, 10, 12, and 22, or 0. But yeah, there's only 5 options you can choose. You can't customize how much tax you want withheld, and you can't withhold state tax from Social Security. Do I have to make estimated payments on a 100,000 Roth conversion January 20 that you did in January 2022 as long as withholdings cover taxes? No. So fast forward to the end of the year, you're going to have whatever sources of income you're going to have: wages, this conversion, capital gain distributions, dividends, interest, rental income if you got a rental property. So long as you end up withholding enough throughout the year, again, doesn't matter when you do withholdings, as long as you withhold enough throughout the year to cover the total year's tax obligation, or at least 90% of it, to avoid the underpayment penalty, you'll be good. You won't have to kick in extra estimated payments. You will have to pay anything you still owe at the end of the tax return, when you do your tax return. But to avoid the underpayment penalty, at least, you don't have to make estimated payments if your withholdings are going to cover all of it, or at least 90% of your total tax obligation for the year. Filling out tax extension form with federal, does it automatically take care of extension for state? I don't believe so. That's a good question. This is kind of the only time I've ever done an extension is for people in Texas, coincidentally, who don't have state income tax returns. So I didn't have to worry about it. I think you have to do states independent of federal. I could be wrong, but I believe you do. So pay online. There's that slide I showed before. Here is for the IRS, at least, it's irs.gov/payments, and just follow the prompts there. For your state, just Google it. If you live in New York, just Google New York state estimated tax payments, and I'm almost certain the top search result is going to be the link you need to pay whatever state you're in, or New York in my example, but whatever states do the same thing. Good question. So someone responded to another question. If using funds within a 401k account to pay taxes for a large Roth conversion in January, do you still owe any estimated tax if you have 100% withheld for taxes? We will fall within the 24% tax bracket using that percentage as the conversion type. Okay. No. So you can have 401k distributions, just like IRA distributions are a source from which you can have taxes withheld, federal and likely state taxes withheld. If you are over 59 and a half, you can do that. You can take, in effect, you're taking a distribution from your 401k and having some or all of it withheld as taxes. You can definitely do that. If you're assuming your administrator allows it. They may limit you to only have like 20% tax withheld at 30 or whatever. They may not let you do 100, but if they can or will, great, then that can do it. That can solve it. If you're under 59 and a half, no, you'll be subject to, you may not. You may be subject to a 10% early withdrawal penalty from taking this distribution. The exception would be the rule of 55, not to get too off on a tangent, but that's one possible exemption or exclusion, where if you left that employer in the year you turned 55 or older, you may not be subject to the 10% penalty on the distribution, even though you're under 59 and a half. So yes, this would work. And a cool trick that John Munn brought up in the group before, remember withholdings are sort of magical, or at least compared to estimated payments, because it doesn't matter when in the year you do it. So a neat trick is, let's assume you're going throughout the year and you realize in December, oops, I didn't pay enough tax or have enough tax withheld for the year. What you can do is you can make an IRA distribution. Now, if you're over 59 and a half, this works because you won't have the 10% penalty. If you're under 59 and a half, you will have the penalty. or your 401k, maybe you can take a distribution from that, like I said. You let's say you owe another $3,000 in tax for the year. You can do a $3,000 distribution from your IRA and have 100% of it withheld for taxes. So all $3,000 gets paid right to the taxing authority, and boom, you just paid the additional taxes owed. Works great. Now the rub is that $3,000 distribution is going to be additional taxable income in and of itself. So you get a bit of circular math here. If you had $100,000 of income for the year and you owed whatever $15,000 in taxes, and you only withheld 12 so far, so you're 3,000 short, and you now do this trick of taking a new $3,000 IRA distribution and withholding 100% of his taxes, yeah, that'll be another $3,000 of tax withheld, but it's another $3,000 of gross income. So on top of the $100,000 of income you already had for the year, you now have another three. So now you have $103,000 of gross income. So your tax bill is going to be slightly higher than the 15 it originally was, because you now have that much more income. So you kind of have to play around with the numbers and to make this work. But point is, this IRA distribution, to have it all withheld as tax, is a really great trick to make a withholdings, because again, withholdings don't matter. You can do this on December 31st. As long as you withhold enough throughout the year, at any point in the year, you can avoid underpayment penalties. So neat little tip. Dinkytown, right? That's right. Dinkytown.net has a lot of free tax stuff. With Tax Cuts and Jobs Act, 750,000 limit on more. Man, Thomas Wang getting real in the weeds with tax stuff. I can tell someone's in the middle of doing his tax return right now. With Tax Cuts and Jobs Act, $750,000 limit on mortgage interest is per property, per person, or per return. That's a good one. I think per return. I mean, it's not per property. You can't have three different property. It's only it's only primary residence. So that by default means one property. If you're married, you can't have two different primary residences. There's only going to be one primary tax residence. So even if you and your spouse live apart, you're still one residence. So functionally, it's all the same thing. It's really per property, per return, if that makes sense, Thomas. So hopefully I answered the question. Tony, TurboTax, it does have an estimated tax function. It printed out 4 forms of my tax return to pay my estimated tax for 2022 with proper due dates. Yeah. So I just to make sure we're talking about the same thing. So TurboTax, definitely what it has is it'll look after it does your 2021 return, for example. Let's assume you were short paying tax for the year and you owe $5,000 with your return. TurboTax will automatically generate vouchers for you to pay, another $5,000 in tax for 2022, because it's assuming your 2022 tax scenario income withholdings are going to be the same as they were in 2021. And since in 2021 you were $5,000 short in tax, it's going to say, okay, you should be paying another $1,250 a quarter in estimated taxes. So it'll automatically generate those vouchers for you. That's not the same as doing a true pro forma 2022, where you can manually add in additional amounts of income you think you're going to have. So just to make sure we're talking about the same thing, I do think TurboTax has that manually adjust your projected 2022 function. You may have to pay extra for it. But possibly what you're referring to, or at least what I think TurboTax does by default, is it assumes 2021 will replicate itself in 2022. If it thinks you're going to be short taxes, it'll automatically spit out for you the estimated payment amounts you should be making. Interesting that box 2A on that safe harbor thing doesn't include the 110% of last year's taxes for high income earners. It does actually, Bruce. It was a footnote, but let me hide your comment here. Box 2B, look at the little double asterisk thing here. It's this footnote here. Instead of 100%, it's 110% if your income is more than $150,000. So So there's that. All right. Mark Troutman sharing another helpful calculator. Thank you for that, Mark. Dave Myers, always useful info from him. Heads up regarding safe harbor. Since you just mentioned 1 million, some states have different safe harbor rules. Great point. In California, if your adjusted gross income is more than 1 million, there is no safe harbor. Interesting. Good to know. Yeah, I should always preface that with any tax discussion. By default, usually what I or any other website's talking about is federal taxes when they say this, that, and the other. Uh, always pay attention to state taxes because a lot of states have their own unique twists and turns, as Dave Myers mentions, especially California and New Jersey, notoriously jerky and notoriously disjointed in their tax codes and tax treatments compared to the federal, whereas most states kind of piggyback off the federal, make small tweaks. New Jersey and California really kind of just like completely redo their tax returns from the ground up, or their tax codes, I should say, more or less. Especially New Jersey, that it truly is. It's its own. Like most state returns start with your federal AGI, then make some tweaks to it. New Jersey, there is no federal starting point. It's just it starts its own return from scratch, which is really annoying. But yeah, great point, Dave. Man, Thomas Wang, I should be sending you a bill for this. Last year, first 12,000 unemployment payment was tax free. This year is the same, correct? No, I don't think so. I could be wrong. I know for certain. I haven't. No, I don't think so. So for 20, I don't even know what year we're in. For 2020, as part of the coronavirus relief thing, there was an exemption. The first, I think it was 10,000 or 10,500? I forget. The first 10,000 ish of unemployment income was exempt from federal taxation. That did not carry over into 2021 tax year. If someone else knows otherwise, correct me if I'm wrong, but I don't believe there's any exclusion or exemption from unemployment, at least at the federal level. States are different. Like New Jersey, for example, doesn't tax unemployment unemployment insurance, but federal does. Dave Myers again, by state, it varies by state. So in California, if you file federal and you don't need to send money into California, you don't need to file anything. If you do need to send money, you do. Yeah, okay. So always check states. States many times may be similar to federal, but always check just to be sure, because it's not always going to be the case. How large can the underpayment tax penalties be? Is it even worth worrying about getting it perfect? Getting it perfect, no. And frankly, you probably won't be able to, because in many cases, there are some sources of income you simply can't know with certainty until they happen. Like last year, great example. Anyone who owned mutual funds in regular taxable brokerage accounts, particularly actively managed mutual funds or Vanguard target date retirement funds in a regular taxable brokerage account, got paid fairly large capital gain distributions that are taxable income. And a lot of people were taken by surprise and didn't know about it until they got their 1099s in January, February this year. Like, wait, what? My income's substantially larger than I thought it was going to be. So a lot of people underpaid taxes for 2021 because of these capital gain distributions, amongst other reasons possibly. But how much does it matter? So just do the basic math. Like I said, the interest penalty is going to be 4% this year. So let's assume you were short paying tax by $1,000, and there's going to be a 4% penalty on that. It's not, even if that 4% applied on the whole $1,000 for the whole year, that's only what? That's $40 of underpayment penalty. But it's even not that much, because like I said, the underpayment penalty isn't a flat 4% for the whole year. The IRS breaks up that $1,000 and assumed you should have paid $250 of it in the first quarter, $250 in the second, $250 in the third, $250 in the fourth. So that 4% annual interest penalty doesn't apply on the whole $1,000. It only applies on the first $250 from April 15th of last year onward. So it's only 3/4 of a year basically that they're charging you interest on that $250. The next $250, they're only charging you that interest for only half a year, roughly from June 15th onward. The third installment in that $250, they're only charging you interest basically for the last quarter. So no, on $1,000 underpayment, the interest penalty is going to be at most $15, maybe. I don't know, just throwing a number out there. I'd be surprised if it's more than 20. Just trying to do the math in my head quickly. 20-ish, let's say. So no, not that big. Now, if it's tens of thousands of dollars, now you're talking a few $100s of interest penalty, but still not not huge. If you owe $100,000 of tax short, that's going to be a lot of money. So don't lose sleep over this. I've personally paid underpayment penalties, to the tunes of tens of dollars. One time, like $100. And this was before I was really paying attention to this stuff in this business. This was like 5-6 years ago. But you don't have to avoid them at all costs. Try to avoid if you can, but if you're close enough, that's good enough. Don't sweat having to cough up an extra $17 or something in interest. At least that's my opinion. Some people fight tooth and nail to not pay more than a penny than they need to the IRS. For me, it's like whatever. At some point, it's not worth the hassle, especially if it's only tens of dollars we're talking about. Or such is my view. Mark Troutman, unemployment income up to $10,000 was exempt in 2020. Yeah, okay. Fully taxable in 2021. So right, they didn't extend that waiver, that exemption into 2021. Thanks, Mark. David Fultz, why did the interest penalty increase from 3 to 4? How is it determined? I don't know. It is based on some sort of general market environment of interest rates. I don't know specifically what they key it off of, or if there's some sort of add-on to it. But it is formulaic to my knowledge. I don't know the formula. So it decreased down to 3. It was higher. It decreased 2020, I guess, when pandemic happened and interest rates came crashing down. This interest came down as well. So it might be some sort of base rate plus 3% possibly, because 3% was like the terminal floor that it hit. So anyway, so since it's going up. I don't know the formula, but if you Google it, you can probably find it. Again, it's going up because market interest rates, the general level of interest rates are going up. That's what they key it off of. If you have zero income and not collecting Social Security, but plan to get distribution from my 401k, is there a link or website I could play how much I can convert to avoid being taxed? That's some next level stuff right there. I mean, yes, there are like the links that folks in the group shared, like Dinky Town and that one that Mark Troutman shared. It's not going to spoon feed to you like, okay, tell me how much you want to convert and I'll back into how much you can do without paying tax. It's not going to be like that. You're going to have to plug and play in these sort of like dummy mock tax returns, plug and play the different numbers and just look at the resulting tax amount to see how much you can hit, how much you can convert before you hit whatever kind of tax target you're shooting for. That's the best way to do it. Okay, Cody Garrett, for those that didn't see it, great YouTube video about the Vanguard capital gains incident. There is actually a class action lawsuit. I don't know how far it's going to get, but there's a class action lawsuit getting put forth about Vanguard and the freakishly large capital gain distributions in the retail share class of the target date mutual funds last year. Any other? Oh yeah, other comments. Here we go. David Fultz, the rescue. So I'm sorry, David Myers to the rescue for David Fultz. The rate of interest is determined on a quarterly basis for taxpayers other than corporations. The overpayment short-term rate plus 3 percentage points. I don't know what specific federal short-term rate. My guess is federal funds rate, Dave Myers, which is has been bumping around 0. Now it's going to get ticked up by 0.25% at a time. There's going to be 6 increases this year so far, or apparently. Ooh. How did Facebook profile pic show up when questions asked? So at the top of this post, top of this video, there should be a link. It's this generic looking message. It looks like it's from me, but it's not. It's from StreamYard, the software I'm using to stream. It should say something along the lines of you have to click here and opt in to allow Facebook to share your name and picture with StreamYard, because by default, Facebook doesn't allow user info like names and pictures to show up through third-party streaming apps like StreamYard, which is what I'm using now, without the Facebook users opting into it. So check the top of this post. There should be a link and instructions there. Mark Troutman to the rescue. Thank you, Mark. There you go. Beat me to it. So this is in response to that person. Okay. Any other questions? I'll stick around for a handful more minutes here. David Fultz as well, sharing the link. So I'll let you all in on a secret. I'm going to be substantially cutting back the frequency and amount of these lives. Been doing them every week religiously, Wednesday night live, for a better part of 2 years now. After April, I don't quite know exactly what the format and cadence is going to be, but after April, we'll be cutting these back to at most twice a month. maybe once. What I'm thinking so far is probably still do a monthly mailbag, free for all of questions once a month, plus possibly one other each month, and that other is going to be either a guest of some sort or one of these sort of deep dive things. So anyway, just thought I'd let y'all know that kind of after 2 years that it's starting to feel like a grind. Blocking off every Wednesday night, to do these, which is part of the reason why Cody started doing one a month, because he enjoys doing it and he has some stuff he wanted to share. Plus also to take some of the time commitment off my shoulders. Plus, we kind of already covered most topics, right? And even the guests, like we've had guests on to hit all the major ones: reverse mortgages, long-term care, Medicare. I don't even know what else do we do. Social Security, all kinds of fun stuff. So, trying to figure out other guests to get is starting to become like more of a chore, figuring out other fresh topics to do. And even topics like this, like I already did this exact same topic some point last year. So the videos are out there. Going to, kind of figure out going forward what these special topics will be in addition to the mailbags when they seem to make sense. So we're not just kind of repeating the same topics and content over time. Anyway, that's that for now. Any other comments and questions? Mark Troutman going into semi-retirement. No, still fully at it. I mean, as you all know, I think most of you know, I hit capacity in my business, so no more new clients for me. That's filled up. So I got a full load of work there, plus tax returns in the spring. Plus I am member coach in the Rock Retirement Club. Not that that's a crazy burden of my time, but I fairly active in things I do there. Plus started the podcast. Part of the reason why I did the podcast was I do truly enjoy teaching, educating, maybe part of it's hearing myself talk. I don't know. But the podcast is nice because it's not live. Like I don't have to give up every Wednesday night for the rest of my life. I can record at my leisure and, schedule the releases to happen every Thursday morning like they do. The next one's going to be out tonight, Thursday 1 a.m. They come out every week. So anyway, so I'm still going to continue doing the podcast. I'll still be here in the group answering questions and stuff and still doing these once or twice a month videos. But I just I'm at the point where, keeping up this weekly live video things become a little much. Plus I truly feel we already covered the vast majority of what there is to cover in one way, shape, or form. So that's that. Thank you all. I will see you. Will I see you next week? I don't remember what next week's topic is. I'm sure it's something good. So until then, I will see you around the group. Hope you got a lot out of tonight. Thanks for watching. Take care.